All right, this house in Lynnwood, Washington is listed at $1.195 million, and we're going to walk through a real mortgage quote to talk about what your monthly payment would look like on this house and what it would be like to buy this house in general. So we're going to look at the numbers, specifically the financing side, because I know that when you're looking around in the early stages of buying a house and you're trying to find just a sense of where your numbers are going to be at, how much cash would you need, how much would your monthly payment be, could you qualify for this loan? It can sometimes be frustrating figuring out which information to rely on, and just knowing, mortgage calculators, online calculators are not always super reliable. Typically they're not always a really good estimate of what to expect. So we're going to actually walk through a real quote that I pulled today on this house and show you what your monthly payment would be. We'll talk about how much cash you would need to bring all in, and then we'll talk about how much income it would take to qualify for the loan. We're going to look at two different scenarios. We're going to look at one, and both of these are just going to be assuming you're coming in with some cash. We're not looking at really small down payments on this kind of house, on this price point. We're assuming you're coming in with some cash. So we're going to look at one where you're bringing 40% down for the down payment and one where you're bringing 70% down. So we'll talk about how much cash you would need with your closing costs and your down payment, and we'll get into all the numbers here in just 1 second. If you're wondering how reliable these numbers are specifically, my name is Lynnwood. I work with Cleveland Street Mortgage, a mortgage broker based in Bothell, Washington. So this is a real quote that we are pulling on this house based on numbers today. It doesn't mean it's going to be the exact numbers you're going to get. It's still not the exact interest rate you might end up with, and all the pricing they're real numbers. But they're based on certain assumptions about your credit score and about your income and just various things that impact your pricing. So be aware that they are real numbers, but the assumptions that I'm making going in might be slightly different to your financial scenario that might impact your pricing. All right, so let's go ahead and look at the quotes here. On the right, you can see this is the 40% down scenario, and on the left is the 70% down scenario. So whichever one you end up being closer to, obviously that one's going to be more relevant to you, but it will be helpful. It's helpful when you're coming into the mortgage process to not just think of things in the abstract of, what does 70% down get me? But how does 70% down differ from 40% down in terms of my interest rate, in terms of my total monthly payment? And just get a picture of what your options are. And be informed about why the numbers are what they are as compared to other loan amounts, other down payment amounts, and things like that. So hopefully walking through them both will be helpful for you. Real quick, you can see up top, I'm assuming a credit score of 740. You're familiar with the fact that higher credit score is better pricing. Lower credit score is worse pricing. But just so you know which number I'm using. If you're relatively close to this, it's not like just because you're 780 these numbers aren't going to be relevant to you, or just because you're 700 these numbers aren't going to be relevant to you, but just bear that in mind as far as what the impact will be. They're still going to be relevant numbers for sure. If you start to get way different, especially going down, if you got down into the 600s, and specifically if you got below 620, then if you're in that range, then things are going to be pretty significantly different. But otherwise, for the most part, it's better. It's realistically better. It's realistically worse, depending on your credit score. But it's just kind of incrementally, and it's not typically drastic. So let's go ahead and look at the numbers. All right, the total payment for we're going to walk through the 40% down first. The total monthly payment is $5,513. And there are three components here. We don't have homeowners insurance we don't have mortgage insurance on either of these because we are above 20% down on our down payment. So homeowners insurance is $175 per month. That's what I'm estimating, and that will vary. It will vary depending on how much coverage you're getting, and it will vary depending on who your provider is. Just some insurance providers are more expensive than others, but so that will vary. But that is a pretty reasonable estimate, a pretty common number that we see for this kind of price point in our area. I think our area tends to be a little bit cheaper on homeowners insurance than maybe other areas that have more natural threats going on. So taxes of $507 per month. That number is drawn from the county website for this property for 2024, so that is the actual number you can expect. The taxes on Zillow aren't always super accurate, but you can go to the county website and see what the actual number is going to be. Principal and interest of $4,831. That's based on a loan amount of $717,000. Since we're at 40% down, this 60% is the loan to value, which is just the flip side of your down payment. Interest rate of 7.125%. Again, not an advertisement, but that is, that's a real number based on the assumptions I am making coming into this. And it is a good idea of where we're at, generally speaking, as far as interest rates right now in the beginning of May. I'm making this video on May 9th. Monthly payment. This is just showing your monthly payment, not including your taxes and insurance. It's just like from the lender's perspective. Even though those things will be included in your mortgage payment, typically, it would be very rare. There are exceptions. If you really wanted, you can look into those to being able to pay those things on your own outside of your mortgage payment. But typically, they're going to be included in your mortgage payment, and they are always going to be included in your payment as far as figuring out how much you can qualify for, which we'll talk about in a second. Points or credit. We're taking a credit of 1,176 to get this interest rate. Points are a fee you can pay in order to get a lower interest rate. You just pay cash up front in order to get a lower interest rate. And credit is the flip side of that, where you can take a higher interest rate in order to get the lender to give you some cash to cover some of your closing costs. Now, the reason these are not zero is just because that's just the way lenders price their loans. They basically show you how much money would you receive for taking this interest rate, or how much money would it cost to get this interest rate at various increments, typically in 1/8 point increments, and they just typically it's not ever zero. And in fact, this number is $1,000, which, okay, what's going on there? That seems like a lot, and yes, it is a decent amount to be aware of, but as far as moving the needle on this interest rate, it's not like it's not like that's doing a lot of damage here. On a loan amount of $700,000, it would take $5,000 or $10,000 to move the needle at all noticeably on your interest rate here, and then you can end up paying closer to $20,000 or $30,000 in points to get it down, closer to maybe the mid fives here. So that's just context for. Yes, this is not zero, but it's pretty close to zero as far as points go. 30-day lock period. When you get your interest rate, you have to lock it for a certain period of time, 30, 45, 60. It will be various times, but typically 30 is pretty common and plenty to do the job. No prepayment penalty. Lender fees of $1,195. That's just when you're going to have to pay the lender some amount of lender fees typically. It's very rare for there to be zero. There's almost always going to be some. Just keep an eye on that number, because it could get $5,000, $10,000, and then your closing costs really stack up, and you're just paying a lot of fees to get the loan. So keep an eye out for that, but typically you're going to be paying some there. So beyond your down payment, you're going to have to pay closing costs, and with this loan amount and this purchase price, the amount of closing costs you have to pay are going to be impacted by your loan amount and your purchase price. With this loan amount and this purchase price, we're going to be at $13,000 is the estimate. It's going to vary. It's going to depend on several things, but it's going to be a good bit higher since we're at a loan amount of $700,000 and a purchase price of over $1 million. Estimated cash to close, your down payment plus your closing costs, all the cash you're going to have to bring all into this deal is just under $500, $492,428. All right, let's look at the 70% down, and I'll just kind of zip through these numbers, and then we'll talk about, for the two different scenarios, how much income would it take to qualify to get approval from the lender to take on that loan. So for the 70% down, your monthly payment drops down to $3,098. Still no mortgage insurance, homeowner's insurance, and taxes are both going to be the same because those are dependent on the house, not the loan structure. Principal and interest of $24.15 based on a much smaller loan amount of $358,000 and an interest rate of 7.125%. The interest rate in this case didn't change just because it's a smaller loan amount didn't change the interest rate in this case, and just the change in your down payment percentage. Sometimes it will, but what it did change is, so in a sense it changed your interest rate because now it's only, you're taking a credit of $588 to get that interest rate. So it's a little bit different there in that sense. You're only getting a credit of $588 to get that interest rate, so it does change a little bit there. Because the lenders have some weird reasons for why they price their loans the way they do, and it's a combination of so many different factors, but in this case that change in loan amount and down payment percentage did change the amount, the cost, or the credit to take that interest rate. So again, 30-day lock, no prepayment penalty, which just means you don't have to pay a penalty for paying off your loan early. And then $1,195, same in lender fees. Other closing costs now of $12,142. It dropped about $1,000. Part of that is because we are taking it's basically we have a much smaller loan amount, and it's offset slightly because now we are only getting $580 in a credit rather than $1,100 in a credit, so that's offset slightly. That's factored in here, but because the loan amount is so much smaller, the closing costs are going to be much lower. So cash all in, our 70% down payment plus our closing costs of $12,000. You're going to need to bring $850,000 to the closing table in order to get this loan. But would you be able to get this loan? Would you get approval for this loan based on your income? So basically the way that qualifying works, the way that lenders figure out whether you can qualify for a loan on conventional loans is your debt to income ratio, your DTI, which is your total monthly debt divided by your gross monthly income. And so your total monthly debts is your new housing payment plus any other monthly debts you have, all added together, divided by what the lenders deem as your gross monthly income. And if that number is less than 50%, then typically a lender will approve you for the loan. You'll be able to take it on. But it's important to note that this number is whatever the number is in the lender's eyes, whatever your income is in the lender's eyes. And typically income needs to, it's scrutinized and needs to meet pretty rigid standards in order to be usable in the lender's eyes. So it's much easier to get it approved with salary. If your salary, it's much more guaranteed and stable. So that's typically pretty straightforward. But if you're any other pay structure, if you work on commission, if you're paid on commission, or you're self-employed, or if you work variable hours, if any of those are true, then it's not always super intuitive to figure out what this number is going to be, and it might not be what you think it is. It might be way less than what you think it is. It might be what the number that you kind of have in your head as your income. It might be pretty close to that, depending on your history, depending on just sometimes where in the, have you filed 2 years taxes for your business? Even if you've been working there 2 years, running your business 2 years, sometimes they want to see 2 years tax statements for your business. Or variable hours, it's dependent on a lot of things that aren't super straightforward. So a lot of times what you think your income might be like twice what the lender says it is. So it might be a lot less. And so that's why getting approved for a loan is sometimes kind of hard. If you are on any of those pay structures, it's very doable. It happens all the time. But it's a lot less straightforward than if you are salary per se. So if that's the case, then basically you just double these. You add whatever your other monthly debts are, and then you double this. And if you're making that much in income monthly, then you would be good to go. So here, I'm going to assume you have no other debts. If you have other debts, you just add them to the number up here and then double it. But I'm going to assume you have no other debts. So basically, we end up with $6,196 per month here that you need to be making in order to qualify for this loan, and then in order to qualify here for the 40% down, you'd have to be making $11,026 per month. I'm going to check those and then also show you what that would be annually. Okay, my mental math skills improve every day. I did get both of these right, and then annually, I'm not quite there yet. I can't do this times 12. But annually, this would be $74,352 that you'd have to be making in this scenario. Again, that's usable income in the lender's eyes. And here, $132,313 per year in order to qualify for this monthly payment. Now, this is qualifying. I'm not talking about affordability or budgeting. I'm not talking about whether you should take on. I'm not saying if you make $130,000 per year, you're good to take this on. You should do that. I'm not saying that. Maybe you should. That's up to you. I don't really care about your budgeting side of things. I'm not giving advice there. It's not financial advice in that sense. I'm just saying if you came with this much income, would you be able to qualify for this loan? Would the lender approve you? Would they say yes, that you can take that loan on? Or what is the amount of income that you would have to be making in order to get approved? So that's what I'm talking about here. If you want to get a quote on a house that you are looking at, we would love to give you a quote. We'd love to see what we could approve you for. Again, I work with Cleveland Street Mortgage based in Bothell, Washington. We do loans in Washington and Idaho. I work closely with my dad. He owns the company and has been doing this for almost 30 years and just has a ton of experience and is involved in every loan that we get to work on and advises clients. And you can see what it's like to work with our team. Look at reviews, and there's a video about our process linked in the description below, so check those out. Again, we're licensed in Washington and Idaho, and we love working with new clients, so please do reach out.